Hi, my name is CH. I have worked as a managed investments product specialist in Singapore for over 15 years and would like to offer, through short video courses, the investments related knowledge that I have picked up throughout the years to anyone who is keen to learn more about investments. This video is part of a series of videos focusing on providing basic yet detailed knowledge on mutual funds for Singapore-based or Singapore-booked investors. This is the third video in a series of videos where we aim to go through the different strategy types of mutual funds. In this video, we will go through more details on sovereign bond funds, investment grade bond funds, and high yield bond funds. Sovereign bond funds, also known as government bond funds, invest in bonds and notes that are issued by countries and governments. Governments around the world run their countries basically like a company. So issuing bonds is a common practice for governments to manage the cash flow and financial planning for their countries. Sovereign bonds are the largest components in the bond markets, with the OECD Global Debt Report stating sovereign bonds at 64 trillion US dollars in size, compared to corporate bonds at 34 trillion US dollars in size as at 2023. The US is the largest issuer of sovereign bonds today, claiming about half the market. This is followed by Japan and Europe. Sovereign bonds tend to have higher credit quality than investment-grade bonds of the same country. As we would expect, a country would have a lower likelihood to become distressed or defaulted compared to a company in that country. As such, sovereign bonds also offer lower return and yield expectations in exchange for the lower risk involved. That being said, sovereign bonds can still exhibit high volatility at times, especially during big interest rate changes. For example, the iShares 20-year US Treasury ETF fell more than 30% in 2022 as a result of the rapid rate hike period. Therefore, they are not necessarily safe capital preservation tools as perceived by some people. The sovereign bond market is highly transparent and efficient. Live prices of bond issues and their respective yields are readily available on trading platforms and public websites. So there is usually not much alpha or arbitrage that can be done by an active fund manager to try to outperform the market. Additionally, there are many well-established ETFs focusing on sovereign bonds for investors to pick and choose from. As such, the sovereign bond mutual funds available in the market today are typically created to cater to specific investor requirements, such as for an institutional investor that prefers investing through mutual fund structure instead of ETF structure, or to fill an offering gap that is not well covered by ETFs. For example, to offer different currency share classes to investors, as most sovereign bond ETFs are available only in US dollars or euro trading currencies. Given the sovereign bond market is highly efficient, fund managers sometimes try to position their fund portfolios slightly differently from the market so that they can try to generate outperformance. The most common approach is to take an active view on interest rate directions and adjust the underlying bond portfolio duration accordingly. Some fund managers also use FX as a returns component if they invest in sovereign bonds from different countries. Here are some slightly more distinct sovereign or sovereign-related bond fund types. Emerging markets local currency bond funds, as the name implies, invest in emerging market sovereign bonds, but focus on using FX as a key returns attributor, as EM currencies tend to have higher volatility against the more stable G7 currencies, and therefore there is potential to generate outperformance if the fund manager gets the currency views right. FX can move quickly and in big magnitudes though, so investors should expect a much bigger returns uncertainty for such funds, as it is possible and likely for a fund manager to take a wrong view in some of his currency bets in the fund. Municipal bond funds are essentially one iteration down from country-level sovereign bonds, investing in US or Europe municipal bonds or local government bonds. They are popular in US and Europe, but are uncommon to be offered in other parts of the world. These are typically viewed by investors as having sovereign-like exposures, but comes with slightly higher returns in exchange for slightly higher risk. Inflation-linked bonds, or ILBs, are also bonds issued by governments, but are specialized bonds that track inflation indices. These are mainly issued in the US and Europe as well. The intent of ILBs are mainly to help investors hedge inflation risk. But through inflation-linked bond funds and ETFs, some investors also use them to generate returns in an inflationary environment or to diversify from normal sovereign bond exposures. Securitized assets include government-affiliated bond issues such as agency and non-agency mortgage-backed securities, or MBS, as well as commercial MBS, commercial mortgage loans, or CMLs, collateralized loan obligations, or CLOs, and asset-backed securities, or ABS. These products tend to have different characteristics and risks compared to normal bonds, and therefore there are some funds that are dedicated to investing in them only. That being said, many bond funds will also categorize US agency MBS and non-agency MBS under government or government-affiliated bond exposures. However, do note that only the ones issued by the Government National Mortgage Association, or GNMA, or commonly called Ginnie Mae, have a direct guarantee by the US government. Here is an example of a sovereign bond fund. This is the BlackRock BGF Global Government Bond Fund, A2 Accumulation US Dollars share class. Its benchmark is the FTSE World Government Bond Index, or WGBI. Performance has been consistently weaker than the benchmark, which is expected. As per previously mentioned, the sovereign bond market is highly efficient, so it is very difficult for a fund manager to outperform. Moreover, this is a retail share class that comes with a high 0.75% management fee, which erodes the returns as well. The fund actually only has about 66% in normal government bonds. There are about 19% in securitized assets and 11% in corporate bonds, which shows the fund strategy has some flexibility in its exposures to allow the fund manager to try to find ways to generate alpha returns. The fund also comes with Euro, Sterling, and Hong Kong dollar currency share classes to facilitate investors with different trading currencies. Investment-grade bond funds are funds that primarily invest in investment-grade corporate bonds. By investment-grade, we mean a credit rating of Baa3 or BBB- and better. This is the most common and popular bond category for retail investors, as investment-grade bonds are perceived to have better yields and returns than sovereign bonds, while having lower risk than high-yield bonds. Investment-grade bonds are issued by companies, so there are a lot of variety of names available in the market, and investors who believe they have a good knowledge on a company tend to be more willing to invest in the bonds issued by that company. The investment-grade bond market is also relatively efficient, and there are quite a lot of ETFs available in the market as well. However, given there are so many different companies in the world, the market is broad and varied enough for fund managers to run their own researches and exercise their bond selection skills in attempt to deliver outperformance. Similar to sovereign bond funds, it is also possible for investment-grade bond funds to try deviate their strategy or portfolio construct from the benchmark in attempt to generate outperformance. One common approach is to overweight into bonds with BBB credit rating. This is because credit rating and bond returns are highly correlated, which means a lower credit rated bond will almost always have a higher yield than a higher credit rated bond issued by the same company. As such, Having a high overweight in the lowest possible investment grade credit rating category can create a portfolio of higher yield expectations than the market average. Another common approach is via the flexibility of the fund strategy, whereby most funds allow for about 20 to 30% of exposures beyond investment grade bonds. Most funds allow for high yield bonds with this allocation, while a few funds even allow for equities. These exposures will certainly drive up the return expectations, but at the same time brings about higher risk into the portfolio as well. Last but not least, investment grade bond funds are also popular with retail investors because many of them offer a wide variety of currency share classes to facilitate the needs of investors that have different trading currencies. Here is an example of an investment grade bond fund. This is the All Spring US Dollars Investment Grade Credit Fund A Distributing Share Class. Its benchmark is the Bloomberg US Credit Total Return US Dollars Index. The fund's performance is a bit inconsistent, with some years outperforming the benchmark and some years lagging. This shows there are opportunities to generate alpha in this market and is dependent on the fund manager's skills. The fund invests mainly in financial sector as banks are a big contributor to corporate bond issues. The fund has adopted the approach to overweight on BBB credit rating bonds, with 52% exposure compared to 44% in the benchmark. As previously mentioned, this is one way to increase the expected portfolio yield. Interestingly, the fund has also decided to invest about 8% in US Treasuries for its strategy flexibility, instead of taking on more risk to go for high yield bonds. This perhaps is to offset the BBB overweight, so that the overall portfolio credit quality remains on par with the benchmark at A- average credit rating. This shows there are many different ways for an investment-grade bond fund manager to tweak his fund portfolio and differentiate the fund from competitors, resulting in a good variety of different funds available for investors to choose from. High-yield bonds are the riskier brothers of investment-grade bonds. They were more commonly known as junk bonds in the past, until probably someone figured out calling them high-yield bonds make much more marketing sense. High-yield bonds are corporate bonds that are credit rated BB+ or worse. The high-yield bond market size is substantially smaller than investment-grade bond market size, but is still broad and varied enough for fund managers to exercise their research and selection skills in attempt to deliver outperformance. One main reason is that default risk is a key risk for high-yield bond markets. So the winning formula for fund managers is to avoid defaults, while clipping the high coupons from these bonds. As such, most high-yield bond funds tend to be more conservative than the benchmark, as they hold mainly BB and B credit-rated bonds and avoid the lower-rated bonds to minimize the risk of getting defaults. High-yield bonds are attractive for the return expectations that are sometimes comparable with equities. Investors should remember high returns always come along with high risk, as there is usually no free lunch in the investment world. That being said, volatility in the high-yield bond market is naturally higher, and some fund managers do make use of event-driven volatility to try generate additional returns. One reason is because high-yield bond funds tend to be issued by companies that are smaller or in need of capital, and therefore are compelled to issue high coupon bonds to attract borrowings from its investors. Any negative news on these companies may lead to a drop in faith of their ability to repay on the bond, and therefore the bond prices may drop drastically. If the negative news are false, that leads to a mispricing situation. If the negative news are real, that leads to a distress situation. Either way, if the company is able to take fast and positive action to relieve the situation, the bond prices may rebound quickly. Fund managers who believe they do enough research on the company and believe the company is able to handle the situation well, will invest in these bonds in hope to catch the rebound and profit. Investors should take note that these are risky bets. A high-yield bond fund should only consider such strategies as a tactical play and not a main return source. Similarly, high-yield bond funds should not invest in defaulted bonds and go through the debt restructuring process in hopes to exit the position at higher prices. Such strategies obviously have liquidity constraints and are more suitable for hedge funds with distressed debt strategies. Here is an example of a high-yield bond fund. This is the Fidelity Global High Yield Fund, a US dollar share class. Performance of the fund was tracking the benchmark until it started underperforming from mid-2022 onwards. You can see from the charts that high-yield bond performances can move in magnitudes similar to equity markets. On credit rating exposure, the fund underweighted BB and overweighted B, which looks to be a move to try to increase the portfolio yield without taking excessive risk. There is also 2.3% in AA, which should be a strategy flexibility to allocate a little into US Treasuries to reduce overall portfolio risk. Yield to maturity is almost 9%, which is comparable to long-term equity returns. Hopefully, this video has provided you some details on sovereign, investment grade, and high-yield bond funds. This concludes this video. Do check out my other videos to find out and learn more about mutual funds. If you find this video useful and would like to see more related contents, please click on like and subscribe to the channel, as well as share this video to someone else that might find this useful too. Last but not least, if you spot any mistakes or inaccurate information in this video, or have any suggestions to help improve this video, please do drop a comment below. Thank you and have a great day.